Good afternoon, everyone. Morning for some, evening for others all over the world. Welcome to today's live trade session. Photo of the week is a photo of my in-laws' cat that was so kind enough to do a photo shoot for me. Today's live trade session is packed. We have a lot to cover today, so I do want to welcome you. Before I do that, I do want to just make a couple of quick announcements. Number one, if you were not here for Monday's live trade session, come January, as in next month, we are actually going to be able to sell stock in Trade Partner. You can buy stock in Trade Partner. You can be a part owner of Trade Partner. And you don't have to buy a lot. You can buy 1 share, you can buy 100 shares, you can buy 5,000 shares. New SEC rules allows us to do this. We're excited to be able to give partial ownership to our users. So be on the lookout for that. Also on December 17th, for those who have been wanting more information about profit stacking, the risk-free calendar spreads, I'm going to do a full webinar on that one topic. And that'll be at 11 a.m. On December 17th. That'll be right before this call on December 17th. You may not automatically have access to it. If you're part of the All Access Pass, then you will get automatic access to it. If you bought the TPO seminar, you'll get access to it. So make sure that you'll have access to that. More information will be coming out here in the next few days. If you don't, call Spring. Give Spring a call. Make sure that you get into the All Access Pass. All right, for those new, welcome on the call. For those new on the call, welcome. Get ahead of myself. I do want to warn you that on these calls, I do not explain everything about these trades. It's impossible for me to do so. As you will see in today's session, today is a prime example of why these calls are so important, why these trade sessions are so important. And so we'll be talking about that today, but I also want to caution you that these trades are fantastic, but they are not the holy grail. Again, today is a perfect example of that being the case. I'll talk about that here in a second. You want to make sure that you start small. There are mistakes that can be made. There are things that you can overlook. I can already tell you that there are trades that a couple of traders made that are not nearly as good as they think they are, and I'll discuss that today. And so you just need to make sure that you understand what you're doing before you start going big. And the best way to do that is to make sure you're making money doing this before you start increasing trade size. If you're struggling making money doing this through execution, through mistakes, through whatever the case is, it's well worth it to stick with it and continue learning until you can tackle it, because the long-term results of being able to compound consistent income on a weekly basis is just tremendous. If you can average $100 a week and then start compounding that, you're talking about growing that in very quickly into as much as $30,000 in about 6 months. And if you continue that for a year, you're talking about growing that into as much as $3 million. If you can't average $100 a week, or if you're not averaging $100 a week, then you can still grow your account very, very quickly. $50 a week will still grow it to over $1 million after only 5 years. You cannot buy a stock and grow a $2,500 account into $1 million in 5 years. You can't do it. No stock is going to do that. The best performing stock over the last 7 years didn't even come close to doing that. So keep that in mind. It's very, very, very critical that you focus on this. All right, so let's get started with today's trade. So first of all, today it's going to be a little bit different because A lot of trades. I trade in several different accounts, and then I also trade through my trade partner, the version that you guys have, and then I have a trade partner that my programmers give me that I test out and play with constantly, which is one you see where we do the spread patterns. Well, the problem right now is that if I put a spread on in one of those platforms, it's not going to show up in the other. So, for example, here's a small account that I started trading with just calendars, so you can see that. And that is one spread position that was made in the in my developers version of Trade Partner, and then same account. Here are the other spreads, but they were made in a different one. So as of right now, these trades, I'm up about not quite $200 on this particular trade, and I started this in a very small account, so that's it's a tremendous gain. I'm probably going to get out of those by the end of the day, if not immediately after the end of this call. So we'll get into that, but I have to do this a little bit different today because of how those are separated in my different accounts. It's not exactly clear by just showing you the spreads. Plus, we're working on something to remedy this, but I do so many leg-ins that the leg-ins don't necessarily show up as spreads. And so we're working on a way that if I leg into a spread, I can then attach it as a spread and put it into the spread position. So a lot of different stuff is coming in Trade Partner to make life a lot easier for keeping track of these types of spreads and whatnot. But before we get to all of those, somebody requested that I touch base on this, and so I'm going to do that at the beginning, because otherwise we're going to run out of time if I don't do it now. So the first thing that I'm going to do is I'm going to show you this, and let me expand that and expand this. All right. So this is the Option Insanity 5-to-1 ratio Option Insanity trade. Okay, and this is one that expires tomorrow. I'm already out of it. So just to kind of give you a recap, here is the trade that I was in. And the trade was in like a 30-cent credit. Actually, I was in several different strikes of this. I think this is the one I showed you guys. But the 362 and the short 5 372s. So the long is actually Friday and the short is actually Monday. But you'll notice that the short is 10 points above the long. So I do one long, 5 shorts, but there's a 10-point strike difference between the two. And so this is where the short option actually expires after the long option, not before. And you can see here that at the time that I placed it on, I think we were trading around 358, 359, 360, somewhere around there. And so the market would have had to go all the way up to 360, 365, 368, 370, 372, and then all the way down to about 374, right? So it would have had to go about 16 points in order for me to reach the risk level. Now, with this particular trade, you have to be very, very cautious. You have to be very careful in how you implement it. And the reason is because this thing will lose money fast if you get beyond the break-even point. And it loses money at about a clip of $300 a point at the beginning, and then it eventually goes to $400 per point is what you're risking to the upside. Obviously, the good thing about this is that you can put them out of the money. Market goes through the profit zone. You generally have many opportunities to exit at a profit, and And the second thing that's really good about this is that the likelihood of the market going up as far as it has to go for you to actually realize any kind of significant loss is ridiculously small. But nonetheless, this is not for smaller accounts. Can't do this in a smaller account. This is for larger accounts. So you do have to be careful of that. Nonetheless, this was the trade that I placed. Let's take a look at where that is at right now. And let's see, 362, 372. So 341. I got in at a credit of 30 cents. It's now at 341. That is a profit of $370 on this trade, and we're basically right in the middle of that profit zone here. So is that, yep, so right here, we actually have quite a bit to go before it ever reaches the risk. I didn't have to exit this, but I did. And the reason I did is because the market, you know, at $300, the market could drop back down tomorrow, you know, 4 points, and I could be, you know, I could see that drop fairly significantly. And for the market to move up, you know, 2 or 3, 4 points tomorrow, you know, I'm going to add to the profit. I don't know how much, but I will definitely add to the profit. But tomorrow is a big announcement day, which is why we still see such value in some of these calls. And so tomorrow morning, it's an outside chance, but you know, the market could pop up really, really high tomorrow, or if one of the you know, this stimulus thing starts happening with Congress and that comes out, you know, that could pop the market higher. So on these, I generally don't like playing around with the risk on these too much. You know, once I start getting into this profit zone, I'm looking for an opportunity to exit, usually about $300, and I am happy to get out at that point. So this one has worked out perfectly. Let's take a look, and I want to show you the in the money ones. So I got in at a 30-cent credit. Now take a look at this 355, 365. We're almost to the 365 level. All right. Or actually, we're past the 365 level. We're trading right now at 367. Okay, that's where we're trading, 367. So we're 2 points past the long strike. If I were to put this particular spread on, this is just showing the pattern of spreads. So this is the if I've gotten into a 355, 365, which I did not, and we're based on where we're trading right now, that thing's trading at a credit of 395. I'd be losing $360. Okay, so that's not a bad deal to be that far past this profit zone. And again, this it would be equivalent to, let's see, this is a 372 shorts, so this would be equivalent to a 374. And of course, right now there's still quite a bit of extrinsic value in those shorts, and so it's showing an open position loss being, you know, at the very end of this profit zone. Okay, that's what we'd be looking at here. But notice, so we'll go to 356, 366. Notice how quickly that loss diminishes with just a single point move down. And then we go to another single point move down. This is 357, 367. So this is right at where the short strike is. And and if I get in at a credit of 30 cents, it's at a debit of 60 cents, right? 66 cents. So this is making $100. It's at the short strike, and that gives lots of opportunities to get out before it ever gets to the risk level. You go another point, the 358, 368, you're already at a debit of 204. That means you'd be making $234 on that trade, et cetera, et cetera. And then we get into, let's see, 341. We're right in the middle. That's actually the best. Nope, the 361, 371. So I want you to notice this real quick. All right. So this is the one I'm in. I'm in the 362, 372. I happen to also be in the 361, 371. Different story. Shouldn't have been in this one, but nonetheless. With this one, I want you to notice that the 361, 371 is in the money or the long is in the money by 1 point further than the 362, 372. So if the market moves up 1 point, this 361, 371, where should it be trading? Right here at 341-ish, right? So you know that, okay, I'm here in, let's say if you get into the 361 and 371, and the one further up is still making money, you're going to be fine if the market moves up. And if the one above that one is still making money, you're going to be fine if the market moves up, right? So, or excuse me, yeah, I completely told that to you backwards. Let me use the graph. All right, so if I'm in one where the current profit is, let's say at 416, and we're not at the peak, then I know I'm going to be fine if the market moves up, right? I'm going to be fine if the market moves up 2, 3, 4 points. That's what this is showing. All right, if I'm in, let's say I'm in the 363, 373. That's barely in the money on the long. If it continues moving up, right, then my profit on this trade should go from a 311 to 342 on a 1 point move up. And if it moves up again, my profit will go from 344 to 358. Again, this is without time passing by, so this would be an instant move. And if it moves up again, I'll be making $345, or the debit would be $345, so it depends on what my credit would be. So if it moves up again another point, I still be making almost $300 if I had an even Steven trade. And if it moved up another point, I'd have almost $200. And so you can see, you can kind of gauge on where the other spreads are at on how good this one is actually, or how much room you actually have for the market to move up for you to be okay on this particular trade. So you can gauge that and decide, okay, you know what, we're getting on the downside. So let's say we move up and instead of a 359 or a 345, now we're on the downside of it and my profit is only 290. Well, that kind of tells you that if it keeps going up, you're going to be losing money or losing profits, I should say. And so that's a good indication of when to get out. Okay. All right. So what about next week? Next week, here are some trades. It's too late to get into next week, pretty much. So here's a 362, 372, the exact same trade that I'm in this week, which is trading at $350 debit. You can actually get into next week's same exact trade at $1.37 credit. Why wouldn't you do this? Well, because you're playing with fire by giving yourself another week to go past the 372 area. That's why. So I don't do that. I go out of the money when I get into these things, and I do so at a credit. So here's the 363, 373. So let's say I go ahead and get into this at let's say $1.40 credit. And well, you know what? Let's do this. I'm going to let's start at 355 and we'll go to 375. So generate those spreads. Now we'll start at 355, 365 instead. We're trading again at 367, right? Look at what this this credit is on this, $12. Now that's because almost the entirety of the shorts are extrinsic value, and I've got 5 of them, right? So there's like $25 worth of shorts there going on. The long is obviously in the money at that point. So this is if it moves up too fast, if you get too close to that risk level and it moves up too fast, you're talking about, potentially suffering a pretty significant loss. Highly unlikely if you put that out of the money. All right, so we'll go back to the one where we were looking at, which is a 362, 372. I know that if the market goes up a point right now, I could lose about $100 on that trade. And if it goes up another point, I'm going to lose another $100 on that trade. And if it goes up another point, now I'm going to be losing, if I get in at a credit of 140, I'm going to be losing about $320 on this trade immediately. So that's why I don't do that. So if you take a look here, the closest one to a credit is a 365, 375, and that makes the 365 already in the money by a couple of points. So not going to do that. Can't go out of the money and get a credit, which is why I say next week's trade is no longer available. So let's look at the following week. And the following week is a whole nother story. And this is going to be really important for the rest of the types of trades that we're going to be talking about today, which are the normal. Well, we'll be taking a look at the crazy calendar trades. But this is the following week. And what's the difference between the following week? If you look at the 360, let's go all the way out of the money to 370, 380. Okay. Look at this credit. You do a 1 to 5 credit of 96 cents. 96 cents. You could actually do 4 shorts, and that's less risk, but you'll still have a credit. Why such a big credit on this? Well, I'll tell you why. Because this week is ex-dividend week, and so between Friday and Monday, there's going to be quite the difference, or actually between Thursday and Friday, there's going to be a little bit of difference in these options, and so you can actually get a really good credit right now going to 370, 380. You will have to be out of this trade on Thursday before, but another reason you can get such a good credit is because there's so much time on this thing. This is so we'd be exiting this exactly 2 weeks from today. So the market has 2 weeks then basically to go up to about 382, 383 before we start to really feel the heat on this trade. And at that point, that's not that far away. It is from the standpoint that we're almost, we're at new all-time highs trading at there right now. But again, with the political stuff, with the stimulus going on, with the vaccines coming out, all of that stuff is, and plus the announcement tomorrow, the economic news stuff that comes out tomorrow, all of this points to, there is the potential a little bit more than normal that we could make that move. But again, all-time highs, I'm not too worried about it. This is one I actually have, the 374, 384, and I have this one from a credit of 50. That puts me way out there. We're talking 20 points, which is basically a 7.5% move over the next 2 weeks, before I even reach the 384. So that's this is the one I have, and I'm going to make $50 no matter what if the market tanks. So that's not bad, and I have this huge profit potential, profit zone to the upside. So here's that trade. And you can see here, the profit potential is not quite as high on this one because of the fact that there will be a difference in the option pricing based on the ex-dividend occurring on Thursday, December 17th, which is actually the day that we'll be having that the webinar. But Is this the 360s? Oh no, this isn't the one I'm in. Not the 367, 377. I'm in the 374, 374, 384. So let me show you how far this one has to go. All right. There we go. We will we'll give you a little bit more view on that. All right. So this is how far this one has to go. I'm going to make 50 bucks on this trade. All right. It's not huge considering the risk, but the probability of success on this is astronomical. Because you're talking about a break-even level if you hold on until the close of 386 when we're trading at 367 right now. So it may or may not happen. So tomorrow, if the market shoots up, I'm still, to 372, I'm still safe. If it meanders up, there is a very, 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 very high probability that I'm going to be able to get out of this trade at a decent profit long before it reaches the risk level. That's why I like this trade. So you just have to have a margin hedge in place, and technically that would be your risk, but the probability is almost not even existent there. All right, so that covers that. Normal option and Sandy trades that I normally look for, not available this week, partly and due because of the high value of the options being retained based on the economic reports that are coming out tomorrow. Tomorrow, you're going to see everything tank, starting after not the market, but the option values, the volatility in the options are going to tank after the announcements tomorrow. So about 10 o'clock a.m. Eastern, from that point on, you're just going to see the value of these options drop tremendously. Which is not a bad thing considering the fact that right now we are in a couple of different ones. So one of the more aggressive ones that I was in was this one right here, which is this is a crazy calendar trade, short 362, long 366, and then the 365 calendar spreads in at a credit of 6. Now we're right in the middle of this thing. Market's trading right now at 366.90. Right, so we're actually 2 points above the calendar spreads right now. So that's actually slightly in the money, and I'm losing basically 35 bucks on this trade. There was a time when this was a small profit as it was going up in here, but this did not offer near the opportunity of getting out at like $100 gain like they normally do around this time, because what you see here on the 365 calendars, you still see a lot of extrinsic value in those calendar spreads. So I'm losing money on that one, and on this one, which is the other one that I'm in, I believe it's, yes, this one, the 364, 368, and then the 367 calendars. So very similar pattern. That's trading at a debit of 45 cents, and I got into that one at a credit of 10. So making money on this one, but these are right at the profit peak, and you can see here the 367s are trading for $1.30. This is not normal. Like I said, it was going to happen this week because the volatility would be retained up until tomorrow. But the problem with this is that if we stay in and the announcement comes out tomorrow and the market shoots up to 372, I'm going to be taking a loss on this, right? So this is one where, if you're really conservative, take a profit and hit the door. $50, you can't complain. Super high probability, and you just take yourself out of the risk equation tomorrow. If you're a little bit more aggressive and you're like, you know what, this is $400 here, almost $500 of extrinsic value that has to come out of these. But you're also going to see the longs drop in value as well. And so it's not quite, you're not going to see this balloon to $400 or $500. You're going to see it balloon probably to about $250 to $300 tomorrow if the market doesn't make a huge move to the upside. So if we're around this this price tomorrow, we'll see this thing balloon significantly. So it really depends on what you're doing, what you want to do. Some, if you're in multiples, that's one of the benefits of being in multiples. You can take a profit on one or two or three or all of them except one and hold on to one. And that one may give you an average, may bump your entire average up for the week significantly. So there's all sorts of things you can do with that. If you are at all out of the money with this, and I am out of the money on several of them, you can see here that those are trading the 367, 371s with a bunch of 370s are trading at 84 cents. That's a debit total. And again, there's still 35 cents on the 370s. We'll probably see that tomorrow. We'll probably see that bump up a little bit, but it's you'll gain value by this 367 dropping down. The 367 will be pretty close to worthless if the market stays the same tomorrow, and you'll see that profit potential balloon up from that, probably by about $100 more. So this is trading at about 85. If you get in for a 10-cent credit, you're making about $100. And tomorrow we'll probably see this around $200 if the market stays around 367-ish, putting those calendars out there. I would not be opposed to holding on to this one, because if the market moves up to 370, then I've got my profit peak there, and that's no big deal. The biggest position I have right now is actually this one, and it's I've got like 140 of these 372s at very cheap, like 18 cents or something. So this one, you kind of have the same deal, right? It's trading at a debit of 70. I got in at a somewhere around like a credit of 5 cents or something. And so making $75 a piece on these, but if the market tanks, I could see that drop, significantly. So I can watch, I could see majority of the profit go back. If the market moves up, I'm going to see this increase to maybe $200. It's probably very, very, very low probability that I'll actually go into the profit peak of 372. So that's probably not going to happen. These 372 calls are actually going for 11 cents a piece. You could exit a couple of those at 11 cents, and if the market screams to the upside, then you can get out of some of the longs for much bigger profit than 38 cents as well. So again, there's all sorts of stuff you can do with this one, but there's never anything wrong with taking the profit, $75 profit on a single position where this thing had just a massive high probability of success on this thing. So that kind of shows you where I'm at. And again, with one of them, in one account, I had a combination of two of these things on with a total of 6 calendars and a total risk of about $400, and I'm making about $200. And the $400 again, almost absolutely impossible to actually be realized on this thing, because the market would have to move up tomorrow to about 374-ish. So it's not the likely thing that's going to happen. It's possible, but it's not likely at all by any long shot of the imagination. All right, so that gives us today's trade. So, depending on where you're at, we'll determine what you want to do. If you're in this one, let's say, and this one was really aggressive, right? where are we at? There it is. So the 362, 366 with the 365 calendars. This was really aggressive. This is kind of my first trade for this week, and it was done like a week and a half ago or something like that. So this was my first ease into this trade, and then I added more at the 364, 368. So I added more of these. And then my biggest trade was when the market shot up a couple of days ago to around 367 on Tuesday. I'd actually gotten into, where is it? Yep, this is the one. I'd actually gotten into a lot of these at a much lower price, and then added the short after I got into the calendars. All right, so if you're in this one, do you get out? Do you stay in? Like I said, if I'm in this one and tomorrow is expiration, I accept the risk of this. This is one of the reasons why this week was different, was because we normally would have had a much bigger profit in this trade, say, for example, yesterday when we were trading around 365 than what we did. We had a profit yesterday, but it wasn't very big at all. And so we just didn't have the same normal opportunity that we have to get out of these trades as it's going through the profit zone as we did, which is, again, one of the reasons why I like going so far out of the money to keep us the highest probability possible. All right, so let's take a look at next week. Actually, this is current calendars. So let's take a look at current calendars. So normally by this time, the 365s that are in the money, they're going for like another 10, 15 cents a piece. The 367s are normally going for about $75, $80 a piece, and they're only going for 60. And why is that? Because these 367s are still hanging on to their value considerably. Those are now slightly in the money. They were trading at like 367.25 right now. So those are hanging on to their value. And that's why we don't see as big of a profit on these trades on Thursday as we normally do. Come Thursday, there's almost no question you can get out of virtually everything you're in if you're anywhere even close to where the calendar spreads are. And they're just not quite there. But you will see this thing balloon tomorrow. Okay. So you'll have to make that decision on, your account, your experience level. And so you should be able to make that decision. All right, so now let's take a look at next week's. And right now, right now what I'm doing is I'm actually doing 5-point spreads. And I'm doing 5-point spreads to create a bigger credit on the trade. So here are 362, 367, and then the 4 calendars are 366. All right, so I did this one. No, I didn't do this one as in a trade, but I put it on here to show you that this one, which is right at where the calendars are, just actually a little bit above where the calendars are, is trading for $1.14. That means the max risk on this trade is $300 and something, $385. That's the max risk on this trade, no matter what, $385. And the market does have to move up, but if the market stays the same, we already know that this particular trade right now is actually trading at a credit of about 30. And so if the market stays the same, we're fine, but it should be trading at a bigger credit than that, or excuse me, at a debit by this time next week, because we won't have the same Friday economic report that will be holding up the value. We are going to see the value of next week's options actually start to drop tomorrow as well. So this one's at the money. You can see it's trading at a credit of 114. We'll go to the first one that is We'll go slightly at the money to out of the money. Here's the 367 short, long 372, and then the 371 calls. And there's 4 of them trading at a credit of 17 cents. These calendars are pretty expensive. The 371s are pretty expensive right now. So this is kind of, in fact, they're almost as expensive as this week's calendars that are trading right now, but they're trading lower because of the value being held on in the Friday options. So this is like above, the 371s are above what I would actually be willing to pay for calendars for next week, which is why I say it's too late really to get into this trade. The only reason you're trading at a credit right now is because you have such a big credit on the 367 to 372 trade. You're looking at about on this one about $170 credit. Yeah, that's why you can pay for these expensive options like that, or excuse me, expensive calendars. Okay. If you want to get into a credit, if you still want to get into one, 368, that's out of the money. Then you got the 373. Then the calendars are at 372. That one's trading a little bit better, but I'm telling you right now, these calendars are not going to be worth a lot next week. If we move up to 372, there's going to be nothing that holds the value into those into the longs, the 372 longs. We're going to be trading at all-time highs. The volatility is going to be out of these things, and we're not going to see near the profit peak or near the profit potential as we normally would on these trades. So I am actually in this at a better price. The 368, 373 is at a better price right now because I got into them like a week ago. So that's, again, next week, depending on where the market goes. If we move up, we're just going to start seeing the volatility come out, and what that means is that the profit peaks just won't be as big. All right. So let's take a look at some of these real quick before I get into the following week's trades. So this is one of the trades that I'm in. Oh, this is, oh, do I not have any of the 12-11s? I don't. You like that graph? Yeah, don't worry about that. That's just because I accidentally pushed this to something else. All right. Well, so rather than spend time on that, let's take a look at the 12-18, 12-21. So there are several traders who communicated to me, at least 2. I don't want to make it sound like I had a whole bunch of people tell me what they got into for next week, but a couple of them got into some trades that they couldn't believe they got into because of how great the price was on those. And I want to show you something. The reason those are not nearly as good as you think they are. So for example, some of these calendars are at, well, let's just pull that up. I'm going to pull up just the calendars. Hang on one second on these trades. 1 second, and I will throw this in for everyone to see as soon as I bring up the right window. Alrighty. So we're gonna do sell a 366 and buy a 366. All right, here we are. So this is the calendar for 12-18 to 12-21, and I'm going to do 360s all the way to 380s. And I'm going to do ones. Generate spread. All right, so we're going to go to out of the money. Let's say 372s. 372s. Look at what the calendars are trading at. 16 cents. 16 cents. Here's the 373s trading at 15 cents. Here's a go all the way to 376s. You're talking about 12-cent calendars. Okay, now there's one good thing about this, and you might be thinking, wow, the price is incredible, blah blah blah. So the good thing about this is that the risk to the downside is only 13 cents. So if you do 375 calendars, you're talking about the risk to the downside is only 13 cents. The risk to the upside is also only 13 cents, no matter what. Okay, so that's the good thing. Another good thing is that it makes it a real easy, or I should say easier, to get risk-free calendars by legging into these. So 375, for example, you can sell at $1.72, and then you place the order to buy the 375 for $1.72. And the probability of it hitting is very, very, very high. Not absolute, but it is very high. And because the market doesn't have to come down very far, it has to come down, basically 13 cents in order. That option has to drop by value at only 13 cents to create a risk-free calendar. And it is risk-free. There's no hidden anything there. It's a risk-free calendar. Where the ex-dividend week throws people off is that the 375s, the long 375s, are really closer to as if they were 376s. The pricing is going to be closer to as if they were 376s, which means that the pricing is more like the long is out of the money by 1 point. So at 375, the 375 longs are not going to be worth as much as the normal at the money Monday longs are worth. They're going to be worth less than that, because it's going to be taking into account the fact that on ex-dividend, they're going to adjust the price of SPY down by the amount of the dividend. It'll be in the overnight hours. By the morning, it could completely be wiped away, but that's going to be priced into that 375 long. That's why these are so cheap, because that is this is basically pricing in the fact that the market is going to be moving down, I think a little more than a point on Thursday before or after the close on 12/17. All right. What that means is that there's not going to be near the profit peak on these trades. It's going to be closer to, let's see here. Where is it? It's going to be closer to this. Okay, so here is the alternative to calendar spreads. You can do the calendar spreads, don't get me wrong, and you can do more of them because of the 13-cent value of these things, right? You can with 13-cent calendars, you can throw 7 of those bad boys into a $1 credit. So $1 you can basically pay for. If you bring in a $1 credit on something, you can basically buy 7 calendars, and so you can make it up, and there will be profit on those calendars, but it's not going to be near as much as what you think it's going to be. And unfortunately, none of the programs take that into consideration. And so you get something like this. Okay, this is a trade that I'm actually in, and I'm in from a credit of 0.1. And I, in order to get this particular trade, I did have to leg into it. So I couldn't get into both, all 4 legs for 1 cent credit at the same time. But look at the risk on this trade. Okay, there is benefit to this from the fact that the risk on this trade is like $1. And that's it. And the reason is, again, because what I'm going to be doing instead of the normal calendar, where is it? My long leg is going to be 1 point under my short. My long leg is going to be 1 point under my short. That's what normalizes it. Now, the cost of that, if we go 375, 374s, right, instead of 375, 375 calendar, the cost of that is going to be about 42 cents. That's more than what we'll normally pay for calendars, especially when they're out of the money by that amount. And you already know that those are the 375s are going for like 13 cents, right? So you're going to pay a little bit more. But what you have is you have a completely different graph that is set up. This is your graph that's set up. Instead of seeing a calendar which comes down and loses money at some point to the upside, this one is guaranteed to make money. And it's guaranteed to make $1 minus the 42-cent credit or debit, which is $58. So that's your profit potential on this trade to the upside. So that's what creates a scenario where you actually have far less risk. This is a lot closer to the MDOP pattern, because the long is actually underneath the short. Is there a problem with that maybe is not being shown here? And the answer is yes. And the problem is that as this is going through the profit zone, you're not going to see near as much of a profit on these particular trades. I want to show you this here. This is a good learning experience for ex-dividend, because a lot of people fall trap into this stuff. Look at where these are at if they go, let's say, in the money. You go right now, that one's trading at 75 cents. If you buy this 368, 367, it's trading at 75 cents. If you buy it at 42 cents and then the market goes in up to that point, you're going to be making $30 on the trade. You can't buy as many, right? So you have that issue. You can't buy as many. So let's say you buy 3, and that's going to give you about $75, $80, $90, somewhere around there. So the question is, how much are you going to be losing on your core at that point? Because the graph on this is much different. It is not a profit peak like this one is showing, right? This is for these. This is the short 369, and the longs are 1 point below, right? So it's not calendars. This one is showing a profit peak like that, but that is not at all what it's going to actually look like. The profit peak over and above the maximum profit potential is actually going to be very small in comparison. It may not be this small because I just absolutely cratered the volatility on this down to 5.5%. Let's see, at 369, let's see what the 369 is being projected to be worth. So the 369, when the market is at 369, is projected to be losing about worth about 75 cents. So it's probably not going to be quite that bad. Probably going to be closer to this. But I wanted to do that just to show you the difference in how this is actually going to look. So if I were to pop these down to, let's say, 0.07. Let's see here. This is probably not far from how it's going to be if you hold on until expiration. You don't see near the structure that you see with the normal calendars. And that's because of that diminished peak and the fact that you have much less risk here. So you bring in a dead zone. Yeah, if you hold on to the last minute, you actually are risking $40, $45 if the market goes nowhere and you hold on to this thing. So it's not nearly as good as what you normally see with these trades. And I will tell you that if you're brand new to this, it's just best to pass by this week. There are, some different things that you can do to take advantage of ex-dividend, but this is one of these where it's not nearly as good as you think. If you want to learn, then throw one of these on. I mean, the max risk here is $100 to the upside, right? You can definitely throw one of these on and you can watch it. And that's what I tell everybody to do anyway. When you put these things on, even if you get out of profit, watch them to the end and you'll see how these things react to the volatility dropping on Thursday and Friday, and especially on ex-dividend. Yeah, I have some ex-dividend strategies that I probably should organize, but you only get to trade them 4 times a year, right? So, but one of them, the calendars are the calendars are not bad. Again, you're just not going to see the kind of profit potential that you would normally see. All right, so I'm going to refresh this and we'll see what these. So the 3. Here's a 15 debit. So 1 second. The ex-dividend does not change the risk. Okay, it does not change the risk. You're not going to see this at 14. The volatility at 14. That's just that's absurd. This is going to be closer to what the calendar is actually going to look like come the end of next week. That profit peak, even with a 15-cent debit, you're talking about a maybe a $60 profit at the peak of these calendars. And so you do have to have more in order to make up the difference on those. But you have that ability. So here is the core trade for 1218, 1221. A 4-point difference in the core trades. And you can see the 374, the 370, 374s are going for $1.34. If you were to do 374 calendars, at 15 cents a piece, now you are talking about being able to put on like 9 of these suckers. So that, that's nothing to sneeze at if you can get, let's say a $50 profit on that. So there is the ability to do something, but you absolutely, if any part of this is in the money on Thursday, 12/17, you have to get out of these because they're going to sign you, and then you got to deal with that, and you don't want to deal with that. It's just, it doesn't really add risk or anything else to the whole scenario, but it does create a pain in the butt to be assigned, and then you don't know how your brokers are going to deal with that because you may be assigned and then they're going to exit your assignment and you're going to have these longs in place, and those longs are going to stay in place. And if they exit your assignment and then the market comes down, you will not have any cover for the value of the longs as they drop. So it can be, a pain in the rear end. All right, so let's put this together real quick. 372, let's do a 372, 376. I want to do the calendars. I'm going to do it 375. And I'm just going to do this because it's quicker. And we already know that those are going for about 15 cents, 14 cents. So we're going to do 7. And that's going to give us a 98-cent debit. And then what do we say? We're going to do, not that, we're going to say 372, 376s for $1.07. 3. So let's go to, which one is that in? That is in SPY 4. So I'm going to add, and don't worry, I'm not going to have the strikes in here. I don't know why the strikes are not showing there. So I'm just going to go 372, 370, 376. All right, so we'll go 372, 376. We should be able to get the whole thing for a credit of about 10. This one shows for a credit of 1, so we'll just stick with that for now. So let me save that, and then we will. All right. So here is the, and we're going to drop this. I mean, we're just going to tank the volatility on here just to be on the safe side. Again, we're not going to hold on to this thing until the close. All right. So we just want to see how small the profit potential is, even though we have 7 calendars on this thing. Okay. So here it is. We'll give you a bit better perspective. 376. Nope, we want to go 370. 378. All right. One more time, we'll update this thing. And on the next PDS trader, which is looking really cool, by the way, on the next PDS trader, that'll actually be on the graph itself, so we don't have to scroll up there. It'll automatically update. All right, so here is the actual trade. If we can get it for a cent credit, you do have this profit potential that is this profit zone, but since we have to be out on Thursday, you don't know for a fact that you'll be able to get out at any kind of decent profit. So that's one of the reasons why I'm not a huge fan of the current trade during ex-dividend week. We'll add the next, we'll go out to the next week, probably starting next week, and things will normalize for us considerably. Okay. Final thing is so this is how I'm doing the risk-free calendars. 1218 375. I have an order in for the 1221 375 longs. Got filled at 170. Obviously, we're moving up right now, 367.50. So we're about 20 cents away from me getting filled on this. I'll just hold this thing until it, we can go up all the way to 372, 373, and I'm still not in danger on this thing. But it's a long way out, and we will see these drop in value if the market stays relatively the same over the next day. And you can go all the way out to like 378s, 379s and do it for $1. And you've got a really high probability of being able to create some risk-free calendars that way. Okay, I knew I had a lot to cover today, so I appreciate the patience. And let's see. Does it give me access to that workshop? Yes, Dan, you will have access to that workshop. That is correct. I had a hard time getting profits from my trade, buying 3 calendars and a credit spread, not showing any profit as today. Is that okay? Should I change credit for diagonal? Well, Juan, you know why? The other reason why I'm glad you pointed that out. 3 calendars is not going to do it. 4 calendars is minimum. 5 calendars is better. If you can put 5 calendars on with the credit, and as long as they are fairly close to the credit, then you're going to have more of an opportunity to get out at a profit earlier in the game. The fewer calendars you have, the lower the probability you're going to have of getting out of a profit during the profit zone, and especially for this week because of what's going on tomorrow. Would I consider setting an automated closing order that triggers when price reaches 370? I'm assuming you're talking about the 5-to-1, and the answer is no, because it depends on when the market hits 370. And by the way, I'm already out of tomorrow's trades. I did not hold on to the 5-1s for tomorrow. On the 1-5 trades, would you recommend for the hedge? The hedge is as far as you can go out, or as close as you can go out, and not pay anything for them, or pay very little. What's the account size needed for Option Insanity? Option Insanity, generally you're going to need at least a $2,500 account to put on a single trade that doesn't have very much risk at all, but because of the margin hedge, they're requiring that. This is not a normal Option Insanity trade, guys. This is a unique Option Insanity opportunity that I trade. It's for larger accounts, for people who understand risk, and don't panic. I have no problem in a $100,000 account. I would have no problem selling out of the money 386 calls, selling 5 386 calls. I would have no problem doing that if I could bring in enough premium, and doing it on a consistent basis. And so this is very similar to that, only instead of just simply having a profit potential of whatever it is you bring in on the calls, you actually have this big bubble. And so you have generally more of a profit potential in those. All right, let's see. How much margin required for 1218, 374, 384, 12 trade? So the margin hedge, let's just take a look at that real quick, since that is a question. You would have to go 321s, and so we'll just go 40, and the margin hedge would actually be, wow, it doesn't even show 387s. So let's see here. So let's see, probably around 405 right now. If you're to do it right now, it'd be about 405, and you might be able to get it for 3 cents, the 405s. So it's on up there. So one of these trades would be required about $10,000 in margin. So my 374, 384, which is this one, requires about $10,000 in margin with the margin hedge at 405. All right. All righty. Which would also be, by the way, the risk if the market goes to 405 on that trade. Can you make these trades in your retirement accounts? You can if you have permissions on those type of option spreads. If you can't, then you need to request it, but you will have to put on the margin hedge. Period. End of story. Can't get around that because it just costs too much. And most retirement accounts aren't going to let you sell naked at call options. So let's see. What are your thoughts about doing 3 calendars instead of 4 on some of the trades to create a bigger credit if the market goes down? I like that, Mark. You just have to realize that when you do that, you're creating a smaller probability of being able to exit as the market is passing through the profit zone. Especially if it does it too early, and then when it does, it's going to be a smaller profit at that. So you just have to be aware that's how it works. Let's see. If the market's, so if you're in the 362, 367 with the calendars, so the 367 calendars are a little, yeah, if you're in a 362, 367, you really want to try and get those calendars closer to your short than 367. And if that's not the case, you need to go for a bigger credit. So tomorrow, if the market does stay around 367 or below, you most likely will see it improve significantly. Let's see. What's your plan to avoid dead zone? On trade SPY 3 you placed, what is your plan to avoid the dead zone? SPY 3. I guess I don't know what SPY 3 is. I don't know which trade you're talking about. No. All right, let's see here. What about looking for calendars for next week tomorrow after 10 a.m. when volatility goes down? You're going to see volatility go down on all the trades. Pretty much next week's is a done deal. It's going to be very difficult to get into trades next week tomorrow. What effect will Tesla have on SPY? I mean, it's one of it would be one of 500 stocks, so not that much. On the risk-free calendars, do you have to do the small leg first? Oh, the sell leg first. Carl, no, you don't have to do the sell leg first, but you have to understand that if you do the long leg first, you have a lower probability of being able to get the risk-free calendar, and you have a higher probability of taking the loss on the long leg without ever being able to execute the short. So that's the main issue. The other issue with doing the sell first is obviously if the market screams to the upside and you don't ever get into the long, then you technically have a short call, which of course you have to have the margin in place to do it that way. Margin hedge in place. Oh, SPY 3. This one. Oh, yeah. So you're not going to be able to avoid the dead zone. I mean, the thing is that this particular trade has to be out Thursday, right? So really, the dead zone's not going to come into play. The question is whether I'm ever going to have any significant chance of getting out at a decent profit, and I don't think I'm going to, just based on how this is structured and how the ex-dividend works. So like I said, for newbies, I think it's one that will need to drop back. Margin will only be a problem if you're going too big. So you can start with 1, right? And with your margin hedge, you're looking at $2,000 margin, and then you can build it. And so you start with 1, get it built, build the next one, build the next one, build the next one. That way your margin never goes more than 2,000. All right. Yeah, this is one of those times where things don't look quite as good right now as they have over the past 2 or 3 months with regard to this trade. But things will get better on this. So just have to get past A, tomorrow, and then B, ex-dividend week, and then C, Christmas week, because Christmas is on a Friday, which means New Year's Day is on a Friday, and that screws everything up. So it's going to be tough going over the next few weeks, but you can try and get into some of these risk-free calendars, and it doesn't, the ex-dividend doesn't matter. None of it matters because you will, there's no possibility of losing money no matter what. as long as you don't get assigned and then they exit your assignment. So that's what you that's the risk in the ex-dividend. All right, let's see. Looks like I got all the questions. Perfect. So we'll get past this next hump, and next week I'm going to introduce something a little bit different for you guys. It's not something that I've done extensively with regard to this specific strategy. So, it's not something that I can give you a whole bunch of history on, but I can tell you that I do this in another strategy with other stocks, the same concept. And if you can be consistent, it is really, really good. So, trying to incorporate that idea into what we're doing, I'm just going to kind of take y'all another step and go through that process. And I'll start that next week, since the next few weeks are going to be kind of slow for us. Not going to be doing a lot of trades for all the reasons that I mentioned. And we can start preparing, and you can start looking at maybe this little tiny variation difference, and that increases the profit potential and the probability of making money on these trades. All right, everyone, have a great weekend, and I will see you guys on Monday.